Trader Merlin show for your Tuesday afternoon edition. We're going to do yesterday we did a lot on kind of long-term investments, taxation, retirements. Today we'll do a little bit of an about face and look at the bond market. As you guys may know, Jerome Powell basically gave the middle finger to the entire financial markets and said, hey, I'm going to do whatever the hell I want to do, and I don't care about the stock market. And, of course, we've been paying for that ever since. Another nice slide today in the S&P of over 1%, making for a pretty ugly almost 4-day slide now. So let's talk about the overall bond market. And as you guys saw from my wonderful graphic I created, I think that this is a rightful title. I got Return to the Bond King with Bill Addiss, and we've got the crown on him and everything. He's joining us, of course, probably from the East Coast. Bill, how you doing, my friend? Welcome back to the show.
It is great to see you, Merlin, and I love your graphics and I love your visuals. Hardly the Bond King. But thank you.
You are the Bond King. Come on. How could you say you're not?
Thank you. Age veteran, if nothing else.
Oh, perfect. All right, let's talk a little bit about. And your microphone sounds a little low on my end. If you can maybe turn your microphone up just a hair. Let's start off with that conversation that happened at Jackson Hole. And I went through on this program, and I went through the whole video, and I cut out just the snippets, and I put all the text on the screen. And for me, it was interesting because he always has this soft tone to him and very calm. And, of course, now I got something stuck in my throat. He's very soothing. Well, this time, it's like he took the gloves off and was just no holds barred, aggressive, almost sharp words. And I'm curious to get your take on what he said and what you think that might mean going forward.
And I really think this is an illustration of what we've talked about, that we microanalyze every nuance, because in actual content, he really didn't say anything new. Now, he did emphasize the inflation issue and said the word 45 times in 8 minutes, like we all counted, so we're microanalyzing this. But I think it was the tone by which he took. But, in terms of content, saying the Fed expects to raise for the next year and everything is data determinant, there really was no policy change. I think it was the emphasis kind of caught the equity market by surprise, because let's be honest, we've had a divergence for weeks, months, between what the equity market has wanted to hear and what the bond markets wanted to hear.
He did mention quite a few things, and you've talked in the past about how Volcker was very almost hidden, non-transparent with his actions. And then we started to see that progression of things becoming more and more transparent, of course, going through Greenspan and Bernanke and Yellen, and then Powell being very, very transparent. What was your thought on him referencing all of the former chairmen and their actions? It almost felt like he was saying, I've kind of screwed up, but, these guys did some things in the past, almost like deflecting some of the blame for this. But what was your take on his commentary about these different Fed chairmen?
No, I think he was looking for comfort, because we have to acknowledge, this problem of stagflation, we've addressed it from the beginning. The only real cure has been a recession. This whole topic of soft landing, that the press loves to talk about, is a great vision and a great, vision. It's not a reality. So, I look at the Fed and I say, hey, they're not even being as honest as the UK is, where, they've gotten downright depressing. Yeah. But, it's not Powell's job to keep the equity market up. That's not one of their mandates. And sometimes I think we forget that. And I'm not saying they don't look at the equity market. Let's not be naive. But, it's not their mandate to keep the equity market going.
Yeah, and he was very clear about that. He said specifically, the markets are going to feel some pain. People will feel pain, it really alluding to the fact that unemployment is probably going to rise. Of course, during the whole 2008 debacle, there was this talk of full employment, and that was 5.5% is what they kept saying. And here we are, kissing 3.5%. It's like, we have plenty of upside pop there. And I think that the shock that he was just so candid about it, because it really did, it felt like this is the first time I've heard him be aggressive in that and saying, you're going to feel some pain, and the markets are going to be in for a little bit of shock, and, brace yourselves. I guess my question would be, what does this mean for the bond markets? We saw, by the way, you owe me 2 beers now because you've been wrong twice on the Fed funds forecast. But I'm still saying 50 basis points. The market right now is pricing in 75 basis points. There's a 75% chance that happening right now. That was a real quick transition. It's kind of surged ever since that speech. So what does this mean for the bond market going forward?
And I'm going to sound like a broken record here, but we got to remember everything once again is data determinant. And that's why even more emphasis, believe it or not, if you can believe it, even more emphasis is going to be played on these inflation numbers versus GDP and the economic indicators.
Mm-hmm.
We are still on that, sword's edge, as to which way the economy is going to go. And we keep stressing we're in uncharted territory here, but, we could go either way. Is inflation going to continue to rear its ugly head, or are we going to experience a recession and the associated downturn in interest rates? And literally, as you're seeing in terms of volatility, like my dance,
Yeah.
on a day-to-day basis, we're seeing that type of volatility as the market is going through it. But the bond market is basically saying more hikes ahead, more inflation ahead. I mean, in the month of August, the 10-year is up by 50 basis points. That's telling you the bond market is still looking for further inflation pain before we get to the recession that is probably coming.
I've got the 10-year bond up here, and it's kind of interesting right now for those who might be listening to the podcast. We're sitting at 3.112 on the 10-year. Now, just going back to, let's say, August 2nd, so the very beginning of this month, we were down on that 10-year to a low point of 2.51. So as Bill says, we're actually 60 basis points up in that 10-year in a very short period of time. What was noteworthy for me, though, was given the shock factor of last Friday in the comments, I really didn't see that 10-year move. The 10-year, I thought, would have a much bigger reaction to that announcement. Again, I think people expecting there to be longer inflation, a little bit more of pain ahead. But the bond market has been really incredibly flat for the past 3 trading sessions.
And not to turn tables on you, but if I could ask a question relative to what you said. When you said the bond market on Friday didn't react to the announcement, what specific announcement are you referring to?
Good point. So it wasn't necessarily an announcement. It was just a tone that you're gonna see some time. You're right. So there was no, definitive. Hey, we're gonna do this, but you
That's my point. That's my point. And I interrupted you. I stepped out.
No, it's great. I love it. But even with statements like that, my gut feeling was, I immediately looked to the equity markets when he made that statement, when he finishes his talk at Jackson Hole, and then of course I went right over to the bond markets, and it was really flat. And normally this is such a dependent on interest rates kind of environment. It really wasn't. The 10-year, like I said, barely moved for the past 3 trading sessions.
And what we're really saying is, again, I'm looking at it from a policy point of view, where the bond market does tend to be more analytical. There was no policy change over the week, and the bond market is reacting accordingly. What I think we're really seeing is, and this is where I'm going to get into territory that's dangerous for me because I'm not an equity market, I think the equity market just kind of woke up to the reality of what they've been saying. And it took Powell to slap them on Friday to get them to see what he's been saying all along.
Yeah, I mean, and it sucks because for me, I positioned myself in a way where I was really expecting these markets to continue on down and have a big sell-off, and then we had this nice rally which got me back in a short-term long. I can't argue that trend, and of course we broke through some supply and talk about a bull trap, and then it just ripped back to the south side. So it's like, there's an old phrase I love in the financial markets. It says, if you go to the cemetery that's full of traders, it's completely packed with people that were 100% right, just a little too early. And I think I'm in that boat.
And I would add, there's no reason to expect this volatility to lessen. We could go through a period of economic data that shows we're going to go into a downturn, and yields could go back down again, followed by inflationary. I mean, we've got this whipsaw, and until we get a clear delineation one way or the other, we're going to experience volatility like we've never seen before in the bond market.
Right. Talk to me about the yield curve. You sent me some great charts here. So, I think we kind of have you on like once a month, so it's kind of perfect to see the updates of it. Let's look at this Treasury yield curve, where we are today. And of course, we've got 3 different periods. You've got 2020, 2021, and then where we are currently in 2022. So talk us through the picture, and let's do theater of the mind because we have a lot of people listening to the podcast right now.
Oh, great. And just what we're looking at in the blue line is the yield curve as of literally this morning. And this is the yield on all of the benchmark outstanding treasuries, the 1 month, 3 month, 1 year, and so on. So what you can see is a graphic representation of what we call the risk-free rates, the bond yields. And the blue line today, you can see, is dramatically different from where the curve was a year ago with the dark gray line, and 2 years ago, the light gray line. And as you all know, and listening to Merlin and others, the yield curve has shifted dynamically where short-term interest rates have come up dramatically because the Fed has told us they're going to raise, and they have raised them, and they've told us of their intention to continue to raise them. And that's being priced into short-term treasuries. The Fed owns and controls the short end of the market. Now, long-term interest rates haven't gone up as much over the last year, but they've certainly gone up rather dramatically. A year ago, the 10-year treasury was under 2%. Now the 10-year treasury is closer to 3.25%. The 30-year treasury was under 2%. Now the 30-year treasury is up at about 3.25. And so the biggest change in interest rates, though, as you can see, is in the shortest end of the market. That differential between 1 year a year ago and 1 year today. A year ago, 1 year interest rates were at zero.
Yeah, it's incredible.
Now 1 year interest rates at 3.5%. So the last year has seen a huge dynamic shift to the yield curve, most of it in the short end, because the Fed has done what they told us they're going to do. They're raising short-term interest rates, and the market believes them. When you see that steep curve from 1 month to 1 year,
Yeah.
Why is the yield curve so steep? Because the Fed told us they're going to raise short-term interest rates over the next year.
Mm-hmm.
And guess what? The market believes them. They've priced it in. So the yield curve has gone through a dramatic shift, which means it's flattened, which also means it's actually inverted, as you can see. The 1 year and the 2 year are higher yielding than the 10-year. There's our dreaded inversion we talk about so often.
And I know you can't see this graphic, Bill, but I'll share for everybody that's watching the stream right now. There's a lot of different ways to view the yield curve, but I found this to be one of the easiest ones, which is just to look at what's the difference right now between two different bond products. And what you're looking at right here is, let me put it on the normal one. This is what most industry will say is the inverted yield curve, and that is the 2 and the 10-year. And that's running right now at negative, let's call it 35 basis points negative. Now, Bill brought a good point many times in this program where he says, look, it's really about the 10 and the 1. You really want to go the short-term one. And even that is still posting a 36 basis points inversion. And even the 30 and the 2-year has a 23 basis point inversion. So not only are they inverted, but they've been inverted for over a month. Normally, you see like a short-term inversion, they kind of bounce right back. But all three of these are steadily underneath that inversion point and drifting even lower as we speak. So just sharing the current status of multiple bond products and yield curves.
Yep. And so the question is, the Fed has told us, looking forward. Let's look at the full, here's the history. Let's look forward. Well, what the Fed has told us is they're going to continue to raise the short end of the market. So we know that end of the curve is going to go higher. The $64 million question is what's going to happen to long-term interest rates.
At this point, again, Bill, $64 million is nothing nowadays. We need to step up your numbers here, buddy. This isn't Austin Powers.
Question. All right, you're right. The 2 billions and anyway, the real question the market is debating is the long end of the market. And again, as I keep stressing, if we think inflation is going to continue to be a problem, long rates are going to continue to go higher. Mm-hmm. If, however, it proves that we are entering that dreaded recession that we're talking about and the corresponding deflation, rates are going to go lower. And this is that whipsawing that we're experiencing right now. Short end secure. We know what's going to happen. The Fed told us. The mystery is the long end. And there is no clear answer here. As Powell keeps saying, data determinant.
What sort of things do you look at to help you understand where that long end may be going? Because obviously, you look at where it's come from since 2020 and 2021. It has certainly increased. We're over a full percentage point higher at this point, but it hasn't risen as much as that short end. And of course, you've mentioned many times it's supply and demand driven. But what are some of those supply and demand factors that you kind of keep an eye on that are, I guess, the most significant on determining that long-term end of the yield curve?
And in my view, because what we're really saying is the long end of the market versus the short end is literally just responding to the economy. That's all it's responding to. Supply and demand, we'll talk about that later, but we've got a steady supply of treasuries in the market. Yields change because demand, in a sense, changes. And what that means is it's responding to economic conditions. So the numbers that are becoming increasingly important in the economic world are the consumer numbers, right? Because the consumer controls 65% of the US economy. And a recession, as the Fed knows, can be a self-fulfilling prophecy. If everyone thinks we're going into a recession, we're going into a recession.
Right.
Because their spending patterns will reflect that. The same is true for corporate America, the purchasing managers survey. What do they think? If purchasing managers think the economy is going to be inflating, they're going to ramp up versus if they're going to have overcapacity. So you got to start looking at consumption patterns And the consumer plays, unfortunately, housing plays a big part of that as well. But the consumer survey numbers that came out today were hugely popular, were usually up. I think that's a good sign. We don't want to see the consumer getting too depressed, because that becomes a self-fulfilling prophecy for a recession.
Yeah, and I think that those numbers, and I can show them to everybody here today. Consumer confidence numbers. Oh, there's no chart of it, but here's from Forex Factory. You guys can see down here near the bottom. There's a couple ones that were pretty positive for the market. JOLTS job openings basically mean there's a ton more jobs than expected open. But the consumer confidence, which I'm highlighting in light blue here, was expected to increase slightly from 95.3 to 97.6. Came out at 103.7 now, or 103.2, excuse me. I got to say, though, my personal thing with consumer confidence is I think that the average consumer is way behind the curve. So by the time they start feeling bad, the markets have already shown them enough pain points. And I don't know. As a trader, I don't necessarily use this one because it's just I haven't felt it being a big impact on me. Now, one that is critical is right above that. You guys see the S&P Case-Shiller Composite 20 Home Price Index. That was year-over-year growth, talking about housing, increasing at 20.5%. Actually came out at 19, or expected to be at 19.2, 18.6. So the slowdown that we've been anticipating here on this show, and I'm sure many of you feel it as well, is not only there, but it's accelerating faster than normal. And you're a bond guy. Obviously, we tie a lot of these things to mortgages, etc. What impact do you feel that the sharply declining prices in real estate may have on these long-term bonds?
Again, it's non-inflationary, it's recessionary. Let's put it that way. Mm-hmm. It's not inflationary. That's the battle we got to go to. Is it inflationary or recessionary? So in today's world, if you're not inflationary, as real estate has been a factor, obviously, in pushing inflationary forces for the last 2 years. Mm-hmm. You're talking about a downturn. You're talking about a downturn in rates going forward if that real estate market continues the downturn it's been in. I also got to throw in the I don't know what $64,000 question is on my mind. But I would also question, I just want to point out on the Fed comments and what we've been talking about. Have you noticed the topic of tapering has disappeared?
Yep.
There's still the question that nobody can answer is, after this month, how much is the Fed going to start destroying? Mm-hmm. And the other question is on mortgages. Realize the mortgage market is kind of manipulated by the Fed now. Are they going to continue to be buyers of mortgage-backed bonds as they continue to be, even though they're not doing quantitative easing? So the mortgage market's still unique, and the Fed's still propping up the mortgage market. Let's be honest.
Lisa asks a good question. Well, there's a few questions coming in. I'll read through some of them here. Lisa says, why are so many banks trying to tell us a recession is not necessary?
Well, I think necessary relative to the inflation argument. Because the traditional economics says you're either worried about inflation or you're worried about the economy. So what the Fed has said, and Powell said it 45 times Friday, we're worried about inflation. That means we're going to raise interest rates. And that means historically, the Fed is going to push us into a recession. Mm-hmm. That's the reality of what's always happened in the past. We don't like to talk about that reality. But what your banker is trying to say is, well, that doesn't necessarily have to happen. And that's true, it doesn't. Doesn't mean it will happen, but yes, that is theoretically possible. I think the bank is just trying to, assuage any concern. I think bankers should be in the business of predicting recessions or not, but that might be a different discussion.
No, they're in the business of making money. And, I think this ties right back into a comment that Tom said here. Tom says, so we should encourage people to get out and spend as normal. That is what the talk track will be from our elected officials. It will be what's from the Fed. I think the Fed actually was kind of contrary to that. Said, almost warning hey, you better tighten up. As I've been saying on this program for a while, watch your expenses, slow things down a little bit, save some money. Don't go out and spend like crazy, but they need you to spend to keep the economy running. So it's kind of this, catch-22 going on right now. But I agree with you, Tom. We'll hear more and more from the powers that be, everything's normal, remain calm as the building is on fire. It's well, maybe I don't want to remain calm. I want to run for the exits quick.
And I'd like to show a contrast that I think is admirable, because on the day that GDP was released 2 weeks ago, the second revision, mm-hmm. and GDP was still negative. Now, that means we have now had 2 consecutive quarters of negative GDP. Now, for anybody who took Economics 101, that was usually the textbook definition of a recession. That means, given that definition, we're in a recession right now. And on that day, not being political, but just a statement, President Biden came out and said, no, we're not in a recession. Again, we don't want to acknowledge what's in front of us. Now, by direct contrast, 2 weeks ago, the Bank of England held their central bank meeting right after our Fed meeting, where the Bank of England said, buckle your seatbelts. We're in for 5 quarters of economic downturn. We're in for a recession that's going to last over a year. And the Central Bank of England said, buckle up, folks, and we're going to see inflation at 13%. I mean, talk about different approaches to kind of similar circumstances. It's just amazing.
Yeah, I don't know whether that's just transparency or not. I'm actually trying to bring up the British pound right here. I don't have the chart in front of me, but yeah, it is interesting seeing how different countries handle these, I guess, the information, the way they spread information to their consumers and their population. So, where was the GDP? You see, had a massive decline in GDP, but I can't find the British pound rate statement. But oh well, I'll have to move on. NJ says bond and equities are behaving the same. Where to go? Now, you're not, a big equity guy, but how do we play this? I've asked you this before, but for all intents and purposes, it would seem that rates are going to be going higher simply because the uncertainty and negativity towards the future. However, we don't know for sure which way that's going to go. How might you play this, knowing what you know about the bond markets and knowing that there's going to be some most likely rate increases in the long term? How do you set yourself up?
Yeah, no, a great question. And there's a couple of different things. Number one is, most people think, and just to take a step back on a more macro level, that, the bond market and the equity market trade inverse to each other. That when one goes up, the other goes down. And I just want to point out that on most days, I would even grant you, that is the case more often than not, but there's no correlation there that's direct. I mean, what we're looking at is, many people, myself included, is for interest rates to continue to go higher. That means bond prices are going to go down.
Right.
But I also personally am expecting equity markets to continue to react the way they have, as they've been slapped by the bond market and rates continue to go up. They're not going to like that either. So we're talking about stock prices also going down. So in this case, we're talking about both going down. So that's why the question is kind of, where do you hide, if that's the question?
Mm-hmm.
And I don't want to address the equity component because I'm not an equity guy, but on the bond side, there's really only 2 things you can do. Number one is bring in your maturities, right? Don't give yourself too much interest rate exposure, because as rates are going up, you want to be able to take advantage of that. So shorten your maturities. Many of you have started to notice now your money market funds are starting to pay some interest.
Right, getting something.
Right? Something. And relative to this yield curve, short-term interest rates are actually pretty high. So, to get yourself in a cash position might not be a bad idea, as long as you're getting compensated with some income. And if the Fed is telling us they're going to continue to raise short-term interest rates for the next year, what you're saying is your short-term investments, like a money market fund, are actually going to continue to rise in yield.
Mm-hmm.
So you're getting at least a little bit more incentivized to get into cash. That's issue number one. And the other issue you can look at, and we've been having this conversation too for the last year as rates were going up, is an inflation-linked product where rising interest rates can help you.
Mm-hmm.
Like a TIPS or an I-bonds and those type of products. So, if you're like me and you think inflation is still not yet under control, then there's no reason not to continue to look at the type of investments we've been talking about in this rising interest rate environment that the chart is showing.
I'll guess I ask this question here from Michael. He says, and we've covered this before, but kind of segued into it. He says, are there I-bonds that are actually paying around 7%? And I think the answer may actually shock you.
Yeah, and Merlin knows it. He led me to say it. So thank you, sir. The interest rate on I-bonds through November 1st is 9.62. Because these bonds are linked to inflation, and inflation has risen so much over the last year, when they did the last reset on May 1st, the new coupon from May 1st to November 1st is 9.62. Now that coupon for everybody changes November 1st relative to what inflation has now done for the last 6 months. But once again, with the exception of last month, which as we know is a very low interesting number, the rate of inflation was continuing to rise. Before last month's number, it looked like the reset for the next 6 months was going to be almost over 9% also. Now, again, we have to wait until November 1st when we've got 6 months worth of inflation data. So don't quote me on that. But the point is, these inflation-linked bonds, 9.62, government guaranteed. I sound like Crazy Eddie. It's been a heck of a yield and an opportunity. And I don't think it's going to dissipate.
Yeah, well, it'll drop a little bit, but there's very few times where you can say, I am in an investment that is beating the rate of inflation and is pretty much risk-free. It's hard to say that. And if you look at this, I brought up the Treasury Direct here. You guys can buy these bonds at treasurydirect.gov. I'm highlighting the first sentence here. It says the initial interest rate on new Series I savings bonds is 9.62%. You can buy I bonds at that rate through October 2022. So if you bought today, you're beating inflation because you're getting 9.62%, and inflation, they say, is right around 8.5. So you're getting 1.1% more than inflation. Pat yourself on the back. But remember, this will readjust. It readjusts twice per year, and that next rate as it comes out could be significantly lower. And of course, the expectation here is that inflation certainly dropped. We saw that with the CPI numbers, the PPI numbers, and last week with the core PCE price index. So inflation, on the surface, at least for this last month, has shown a decline, and we don't know if that's going to continue or not. But at least I bonds allow you to beat that 0.08% that your bank's paying you for your savings account.
Exactly. And I point out, government guaranteed, state and local exempt.
Yeah, you gotta love it.
I mean, they're in direct obligation. Yep.
Yeah, Lori says, I love I bonds. I wish I could buy more. I do too. I think it's a pretty darn good way to go park your cash there. Let's see, a couple questions as I want to get back to these. Do we have any other vehicles? Jay Patel says, do they have any other vehicles to control inflation other than raising interest rates? And the truth is there's really three main ones, but I'm going to let Bill walk through that.
Well, you've got adjusting interest rates in general, because I would point out when the Fed has come in and raised rates, although the press only talks about one, there's a whole range of different rates they change. The Fed funds rate, the discount rate, the repo rate. So it's short-term rates in general, and there's a basket of them that they control. The other thing that they control is the supply of money in the system, which is by way of quantitative easing, printing like they did under QE, and now destroying money, right? That affects the value of currency. It affects the supply of dollars. It affects interest rates. And then the other thing that they did with that money, so it's kind of tangential, is they went out and they bought a boatload of bonds during the pandemic to drive up bond prices and drive down yields to these low yields we're now enjoying. So it's yield curve manipulation. Mm-hmm. So they control short-term interest rates through the Fed funds and other policies, monetary policies. They control the supply of money, and they control basically long-term interest rates by buying and selling bonds in the market.
And I've got yeah, I do. So raising interest rates is one of them. This one here is interesting because this shows you the Fed balance sheet, and you can go to the FederalReserve.gov website and find that information out. What I think is just absolutely hilarious or scary as hell is how back in 2018 you saw them unwinding the balance sheet, right? They were up over $4 trillion, and then they slowly started selling off. And then in 2019, you saw them actually start to accumulate a little bit more to get the economy back on track. It's just not humming on all cylinders. And then COVID hit and was like, whoo, just straight up. We went from $4 trillion to almost $9 trillion just on the Fed's balance sheet alone. There's other balance sheets as well. But notice that right now they are unwinding that balance sheet. They're selling off. You can see on the right edge, at least since March, it's been slowly drifting down. Now, this isn't a massive decline, but it's removing money supply. So they've basically created money out of thin air in a digital ledger, bought these bonds or other products, mortgage-backed securities, and that, of course, surges inflation. Gee, where's your basic economics lessons, guys, here? I mean, you create more money supply, you create inflation. So this is one way to help fight it, is take money out of circulation. The other one was interest rates. And then the third one is when the pandemic hit, banks were required to hold a specific amount called the reserve requirement. And that's when you deposit money, how much cash does the bank need to keep on hand? So if you deposit $10,000 and they have a 10% reserve requirement, they have to keep $1,000 of your money there, right? The other $9,000 they can lend out. Now, that number fluctuates. Right now, it's pegged at zero. The Fed funds or the reserve requirement has been zero, and that was because when the pandemic hit, they basically said, we need you to lend money out. We need to get all of it out in the economy. This is fractional reserve lending, which should scare the hell out of you because basically the bank is taking everybody's money, lending it out. Then you deposit it, and they lend it out again, and it's all of a sudden, a $10,000 deposit might be $80,000 worth of loans out there. And they say we should worry about leverage. So what they can do is they can raise that reserve requirement, which will force banks to stop lending out as much, which will contract money supply and kind of convince people to spend less is the ultimate goal there. So those are the three that I usually focus on.
And Merlin, if I could, I just want to reiterate what you said so brilliantly, is the reserve requirement issue. I mean, think of this. Normally, banks have to set aside a certain amount of their deposits on the reserve at the Fed to manage risk, a safety net. Well, the Fed said under the pandemic, at the time when risk was at its greatest, when bi-party risk was at its greatest, the Fed turned around and said to the banks, you don't have to hold any reserves here. You can freely lend out 100%. And then, as you said, leverage up even from that. I mean, from a risk management point of view, people talk about this must be the risk management committee from Lehman went over to the Fed to do risk management for the Fed. I mean, at a time when there's more risk in the market, we said to the banks, no, you don't need to keep money aside as a reserve.
Now,
Absolutely.
Let me ask the viewers out there. Let me see if they can get it first. But for everybody who's watching right now, in that scenario we just painted, what would you say is probably the single greatest threat to our economy? Based off that information I just presented you, what would you say is like one of these things where if this action happened, everything comes grinding to a halt and we would have a mass hysteria and systemic failure go on in the United States? I'm just curious. I'll give you guys a couple seconds to type it in chat. What do you think that event might be? I'll give you a hint. You had one in the cryptocurrency world happen in May of this year, where everybody had deposited money in the specific cryptocurrency and they saw the warning signs and went, oh crap, I want my money back. So there was a run on the bank, and that bank basically lost $40 billion worth of crypto power of value in about 3 or 4 days. If we get a run on the bank in a situation where the banks have no reserve requirements, none of our money is really there, then this whole house of cards comes screaming down. And I know that that's a far-fetched idea. It's kind of crazy to think that it could be that catastrophic. But, if there is that herd mentality and people start freaking out and there's no money in the banks, what happens, Bill?
Everyone's running for the door. You have a problem. But I think that point has to be reiterated from a risk management point of view. To say to the banks less capital is required is just an absurd answer, and people should be aware of that. And people point out the fact that the Fed is owned by the banks. I'm sure had nothing to do with those type of decisions, right?
Right. Yeah. When the inmates run the prison, some crazy things can happen. So Nader asked a question here, which is good. He says, "What would be the risk factor if I buy I bonds?" So let's just say, if someone were looking at I bonds, saying, "Hey, I like that 9.6% sounds great." What's the risk? Is there can they lose all their investment?
No, there's, as I see it, there's two risks. Number one is a liquidity risk, because when you buy an I bond, you're technically buying a 30-year investment. It's a 30-year certificate. Right. Now, I don't want people to think of it as a 30-year, because the way it works is if you buy an I bond for the first year, you're locked in. You can't get out. You have no. But then after a year, if you want to redeem it back to the government, now you're not going to sell it, you redeem it back to the government, anywhere from after year 1 to year 5, you lose 3 months worth of interest. So think of it like a CD where you redeem it for an interest rate penalty, but you can still get out. You just lose 3 months of accrued interest. But then if you redeem it after 5 years, there's no interest rate penalty at all. So, at worst, think of it as a 5-year investment. But so you have a liquidity risk. You're locked out for a period of time. You also have, interest rate risk, and then specifically inflation risk, because as we were saying, these I bonds are linked to inflation. So for the last year, inflation has roared, and that's resulted in these very high coupons for the I bonds for the last year. Now, what that means is if inflation goes down, or when or as, that means that these coupons will also go down. The very nature of a floating rate product is it's not a one-way, it's a double-edged sword. It can go either way. We've experienced high inflation. These I bond yields are astronomically high relative to the rest of the market. Inflation could go down just as quick. And remember, you're locked in for a year. If the next coupon is a coupon you don't particularly like, you're locked in for a year on this investment.
Yeah. I mean, there's always that risk that the government might default on them. But I mean, come on, if the government defaults, you're not worried about your 10 grand locked up in an I bond.
Exactly. Exactly.
It could be much, much worse. In the way I look at it, I have not purchased them yet. I'm actually going to purchase some here very soon. And the main reason is, even if rates drop, and let's say I lock it at 9.6% through October, and then inflation, hypothetically, is under control, and all of a sudden we get back down to 2%. Even if inflation gets to 2%, how much am I going to earn on that I bond? Roughly 2%, which is far better than any savings account I'm going to put my money in. Even some of these high yielding ones that you can get close to 2, maybe get 2%. But I just think if you're going to hold, if you want to have a savings account, it's going to be for a long time. Instead of buying a CD, I personally would probably go with the I bonds. You can only get 10 grand worth, but your rate of return is so much higher. It just doesn't make sense not to purchase some of those if you have idle cash you know you're not going to use for a few years. All right. So 1 year is no big deal if you think about it, but it's the 5 years really your ultimate goal. That's when you get out from all the 3-month interest penalty.
Right.
Let's see. Aren't we too dependent on paperless payments as an economy if it comes down to for it to come down? No, Echo. I don't think we are not dependent. It's just the way our system is, right? It's a digital economy, and we have digital dollars, but it's still impacts of inflation, deflation, supply and demand. All is still going to reflect in that overall system.
Yeah, I mean, I don't want to walk around with bags of currency hanging off my belt. And from an economic point of view, money that's digital versus money that's paper form is of the same value, right? I mean, and the one is not impacted, and only 4% of our money is paper. The rest is all digital anyway.
Right. Yep. There's a good comment there from Mark. It says, I-bonds are the CDs of the 2020s. Yeah. I mean, as long as think of it like a very long-term CD. Yes, I think that would be a good way to look at it. One last one, and I'll get.
Margaret remembers back when rates were high. Margaret remembers back when rates were higher.
Yeah.
CDs used to be attractive investments.
Liz asked made a more of a comment, really, which I think is an interesting one. Liz says, do you think Powell's change of tone at Jackson Hole was somehow squared by the openness of the other attending the symposium? So I didn't get it. I didn't really listen to anybody else who was presenting. All my eyes are on on Jerome Powell. But do you think, I don't know, did you follow much of it?
No, I have to be honest with you. With training classes, I didn't actually watch much of the symposium, much of the summit itself. Actually, I caught the highlights. I more look at it, not so much as the participants, but just central banks in general. As I said, the UK has been so brutal as to their expectations. Even European Central Bank is waving that cautionary flag now. So I don't know if it's necessarily the participants, because that's a political event as much as anything.
Yeah.
But among central bankers, I think there's a growing acceptance to, we have to accept reality.
Yeah, it was interesting. I've been kind of throwing shade at the ECB because every bank around the world except Japan has been raising rates, and some very aggressively. And the ECB is like, no, we're fine. It's like, really? So the longer you wait, you realize you're exacerbating this problem, which could really hit Europe hard. And I got to be honest, I'm loving it. Europe, you're totally screwing yourself. And why am I happy? Here's a chart of the euro. I'm going over to Oktoberfest and going to travel around Europe for 2 weeks. And I love the thought of me going over there with a sub-parity euro. Bring it on.
And yet at the same time, they're saying with no change in policy, their GDP expectations are going down and their inflation expectations are going up, but no change in policy.
Yeah, shocker there. All right.
Well, exactly.
Bill, tell me a little bit about what you've got going on. I know that you're doing bond classes and you've got your book series, which you can share for everybody as well. I think you actually gave me a graphic for that, which I can share.
Yeah, there's a graphic, and this is over. Last time people have to hear it from me, but no, there's some new things going on with OTA, and I'm pleased about it. People are probably aware there's a whole new series of classes coming out called the Focus Series, which are one-day classes. So I've been asked to put together a focus class for fixed income. And we're going to focus more on the trading side of things. And many people think of bonds as dull and boring, and they fit a certain need for income and safety. But as we're talking in this program, the volatility of the bond market is catching the attention of traders. So we're going to do a class focusing on trading more of the fixed income market, using ETFs and other product futures markets. So I'm looking forward to doing that. That gets me back to my roots, because I was an old futures trader early in my life. But part of my bond career was even on the futures side. So we're going to put that class together. We'll have it on the agenda by the end of the year, and that'll be running on a regular basis as a one day. I'm back on September 27th with an XLT. So I've been doing those monthly, so that's fun. And what else? And as you said, I've got this book series that's at the end of this month is gone. I have to say I'm going to be very proud. I helped train over 3,000 new hires to Wall Street this summer.
Wow.
Many people might be saying, does Wall Street really need 3,000 new employees? But like it or not, they hired 3,000 new employees at the major firms. And those trainings are just finishing up this week. And these are some of the books that I use for those classes. So I've been making them available to the OTA community. So, but that program and the whole summer system shuts down on Labor Day. I get some rest. So
good.
I'm looking forward to getting some rest after the summer months, quite frankly.
Well, good. Maybe that means I get you on this program more. That's even better for me.
You're welcome. It. I love it. I really enjoy the time I spend with you guys. Much more fun than my institutional clients.
Well, I'm sure that one thing I love about it is you get to work with these institutional clients, but we get I'll just say a sprinkling of that education as well on here. So I'm excited to have you on a regular basis. I do appreciate that very much, Bill. Yeah, I guess we're going into, what are we? We're going into September, which means I'll probably get you on near the end of September, maybe get you after the next rate meeting.
You reach out on there.
All right. Oh, and by the way, are we going to do another beer? Because I could use 3 once, but are you going to go? You pick the rate number.
I was going to say, but this time I get to pick the rate number as we get closer. How's that?
Sounds good.
All right. I look forward to it.
All right, Bill. Take care.
Are paying the tab so we can get together soon.
That's right. Nothing like free beers for me. All right, Bill. Well, thank you so much. Have a fantastic remainder of your day, my friend. Take care.
Best wishes to all. Be well.
Bye. All right, guys, that was Bill Addiss giving some insights into the bond market. Margaret, I saw your question that came through. There were others that asked that question. Lisa says, my understanding is after 1 year, I believe they keep 1/4 interest, not 5. We can ask Merlin. So you can sell your bonds after 1 year. So you've got a 1 year lockup period where you can't do anything. Anytime between 1 year and 5 years, they keep 3 months worth of interest. Just up until 5. After 5, you can pretty much do whatever you want with those I bonds and get out of them. But someone was laughing. I said idle cash. Well, I mean, everybody here should have a reserve. You should have some money set aside for, when bad stuff happens. Maybe get laid off or have a personal injury. I think it's really important to kind of set money aside, and maybe putting something in an I bond where it's going to be getting that 9.6% interest at least for another couple months. I think that's a great idea. So there's your clarity on that one about those I bonds. Let's see what else. Tom says, wow, the real world is having layoffs and the ticker world, Wall Street, is hiring 3,000. Well, you got to look at who's doing the hiring, right? It's usually the financial firms. And when they hire those 3,000, I don't think all those 3,000 get jobs. They put them through a training program, and some are going to make the cut, some are not. What always bothered me, I interviewed a guy, his name was Chaim Bodek. And Chaim Bodek was this guy who he figured out how they're doing high-speed HFT, high-frequency trading, and they were co-locating servers and basically stealing money with these computers and robots, which, kind of got swept under the rug there. And one of his comments during my interview, which was a couple years back, he was saying, one of the things that bothers him is you'll have somebody who's one of the brightest chemical engineers. And you got the brightest physicists. These guys are just magna cum laude at their universities from Harvard. And you think, oh, you're a physicist. You're going to go and solve, aerodynamic properties of spaceships to Mars. Or you're a scientist. You're going to come up with a cure for cancer. It's like, no. All these amazing PhD students and master's degrees and the highest graduates all tend to end up going into the finance world, which is kind of depressing. But who do you think is going to pay you more? Some research institute, which you may not get paid much at all, or where you can come right out of college with your master's degree and get paid a hefty 6-figure salary to be coming up with algorithms for the bond market or high-frequency trading. Kind of sad, because I think that if we didn't have that, we probably would have a much better world. I think a lot of technologies might be discovered or at least built upon and made even better. And a lot of the diseases might be cured, but it is what it is. Yes, the Dark Bulls book. That was an interesting one. He was a great interview. Chaim Bodek. This is a great one. He was blacklisted from the industry pretty much when he came out with that book, man. It was pretty ugly. Hey, Merlin, what do you think about borrowing from your portfolio? I'm not a big fan of borrowing from my portfolio. I don't want to be putting leverage on it. So whatever I have in that portfolio is what I have. I don't want to think about over leveraging it. I don't want to take on that undue risk, but that's just me. All right, let me go into, did I put out what was going on for tomorrow? God, been so busy, I didn't even get a chance to look at the economic announcements and earnings for tomorrow. So one quick second as I bring that one up for you guys, because it's the final day of the month. I mean, this is an important one. We got the final day of the month. Here is your economic calendar for tomorrow. As you can see, there's a ton of stuff. You have FOMC member Mester will be speaking for the U.S. The bigger one will be the ADP non-farm employment change, right? That's a biggie coming out at 5:15 Pacific time. So that'll be an hour and 15 before the equity markets open. And of course, all eyes on jobs at this time. You also have Chicago PMI, which will happen 15 minutes after the markets open. And for those of you trading crude oil, you've seen some crazy swings lately in crude oil's price chart. That is crude oil inventories coming out at 7:30, so 1 hour after the markets open tomorrow. Now, if you're trading the euro, which has been pretty choppy right around that parity number, you can see they have some CPI's number coming out, consumer price index, also German unemployment change. And later on, you have German retail sales numbers as well, and the Swiss franc with CPI numbers. Now, the earnings side, it's been pretty boring. I don't see any like major earnings announcements that are noteworthy coming up this week. It's kind of, I mean, there's a couple names maybe, but most of them are really kind of quiet out there. So let me, tomorrow we've got Five Below. That's pretty much it. Viva Systems. I'll call it boring. Okay, that's going to do it for me for today. If you guys liked what Bill Addiss had to talk about, you can visit him at Online Trading Academy. He does some classes there. He's got a focus series and just all kinds of bond. He basically runs everything with bonds, kind of like Cameron and I do for crypto. Bill Addiss is all about the bonds. You can also find out more information at Amherst Training, which is, I put it in the chat there. I think I put it in the chat, unless it's scrolled up here real quick. Yeah, it's aftraining.co. That's Bill's website out there where he has blog posts and all kinds of other good information. Now, tomorrow's show, I'm going to have Jeff Manson on the program, talking about a topic to be determined. We haven't quite decided what we're going to talk about, and if you'd like, you may help shape that discussion. As you guys know, Jeff is very big on price action. He loves Fibonacci and other things like that. So if there's something that you would like to know more about, put them down below the comments on the YouTube video. I will do my best to filter out all the spam that showed up on yesterday's YouTube video, which is just really annoying, but I get to block thousands of people that post spam on those pages. So yes, Tomasina, futures is obviously his sweet spot, but it's what aspect of futures would you like to know more about? Put that in the comments down to YouTube, and I will get that all ready for Jeff for tomorrow's show. Or you can email me at the email on your screen, which is TraderMerlin@gmail.com. That said, happy trading, everybody. And for Big Eb, didn't make it an hour. I'll see you guys tomorrow. Take care.